This content should not be construed as financial or investment advice. I am simply sharing my personal views and perspectives, which I hope will educate and inform and help give you the confidence to make your own financial decisions. If you need financial investment advice, please seek in-person advice from a qualified, experienced, and regulated finance professional. YouTube will not save you.
The explanation lies in how our taxes are designed. Wealth is taxed differently from work in the UK. It always has been, ever since we introduced income taxes in the UK in 1805, and the system favours those who already have money. That is why inequality in this country keeps increasing, and when Margaret Thatcher made changes to our tax system in the 1980s in particular, wealth increased rapidly, and nothing that has been done since has reversed that trend, and that's why we need to change our tax system now. The tax system we have is designed to help both create and preserve wealth, and is designed to impose tax injustice on ordinary people. So, do we need a wealth tax then? My answer remains no.
Hello, I'm the Fourth Accountant, and today we're going to be reacting to a video by Richard J. Murphy. Now, Richard J. Murphy, as you can see on the screen here, is a professor of accounting and also a left-leaning economist as well. So he is somebody that very much I would describe as having a very socialist mindset in terms of how he would like the economy to look based on what he's outlined in many of his videos. And I'll leave a link to his channel and the original video in the comments in the description for this video here, so you can see the original for yourself, which I highly recommend. But he's also somebody who's quite skeptical of the idea of a wealth tax as well. So although he is somebody that acknowledges the need to tax the wealthy more, he is somebody I would suggest that does not believe that a wealth tax is an effective way of doing that. And this is a wealth tax in the mold of what Gabriel Zucman, for example, and Gary Stevenson have described, where it would be a tax on asset or overall wealth, essentially. So I think he's an interesting person to hear from, because obviously, as I say, he is someone that's clearly highly qualified, but also can potentially help challenge our own views around how we see this issue and what we think the potential solutions are. So yeah, let's dive into this video and see what we can learn.
The UK has a wealth problem. The problem is that too few people have too much of our wealth, and most of the rest of us don't have enough. That's a definition of inequality.
Yeah, and this is true, I think, of all nations, right? So whether you think of the developed world or the undeveloped world, wealth inequality is something that exists everywhere. It's a growing problem. And as someone like Gary Stevenson has described very much in his content, for the majority of history, human history, this has always been the case, right? Where the very powerful can leverage their positions to hoard a disproportionate amount of the natural resources and or assets and or by wealth, essentially. So again, this is something that's not really, I would say, new to this time. I think it's just something whereby, because we have a democracy, it's something that comes into the forefront of our minds. And when we think about how the economy should work, it doesn't reflect the taught expectations we have, whereby the implicit assumption is that if you work hard, you will get your fair share of resources and wealth and be able to progress, right? And I think for me, this is why now this issue has become something, that is sort of very polarizing and to the forefront of many people's minds.
And that inequality is causing massive stress, social injustice, and political grievance. And you will have noticed that grievance, all of it is justified by the fact that this is a system that has been chosen by the government. Our tax system lets this wealth inequality happen. As a straightforward matter of fact, the wealthy often pay a lower share of their income in tax than do people on very much lower incomes. That should be impossible, but it is true. We don't have a progressive tax system overall in the UK, especially when it comes to the wealthy, and my research has shown that. We'll provide a link down below to the Taxing Wealth Report where the data is.
Yeah, and it's probably worth checking out that research, actually, to be fair to him. But it depends, again, I think where there's semantics comes into all of this is it depends what you consider progressive. It depends what you consider fair as well. Now, as far as I am concerned, the way I think, for example, Labour, and this has been my big criticism of Labour, as they are the government at the time of recording, is that they consider wealth essentially income, right? So the more you earn, the more you are taxed. And if that is happening in the minds of Labour, that is progressive. And that is actually how the tax system has been designed, essentially. That is the intention, because the idea would be, well, the only way to build wealth is to have a higher income, therefore generating disposable income, and therefore allowing you with that disposable income to save or to buy assets, right? So, in a very sort of simplistic and conventional way, if the system is taxing higher earners more than it's taxing lower earners, one could argue it's progressive, right? The issue you have is that at a certain point in time, you can just have so much wealth, you no longer actually need to work. And then how do you tax somebody that isn't working, but at the same time has a massive asset holding, which is appreciating over time, right? And that's essentially what he's saying implicitly when he says we don't have a progressive tax system. And it's the same criticism actually Gary Stevenson has outlined as well. We don't seem to have a way of solving the problem of somebody not working, but their asset holding is just growing and growing and growing to the point now where we have a trillionaire.
The explanation lies in how our taxes are designed. Wealth is taxed differently from work in the UK. It always has been, ever since we introduced income taxes in the UK in 1805, and the system favours those who already have money. That is why inequality in this country keeps increasing. And when Margaret Thatcher made changes to our tax system in the 1980s in particular, wealth increased rapidly, and nothing that has been done since has reversed that trend. And that's why we need to change our tax system now. And let's be clear, in this context, wealth means having money left over at the end of the week.
Yeah, and this is where I disagree with Richard J. Murphy, as I was sort of outlining in terms of my own challenge around Labour's perspective of what wealth is. Wealth isn't about how much money you have left over at the end of the month. Wealth is about assets. It's about assets you already have, right? So if you have a lot more disposable income, that is obviously a good thing, but that cash is essentially sitting idle unless you do something with it, right? But that cash in itself does not represent wealth, right? Wealth, in my mind, is assets, right? And you can inherit assets, you can be gifted assets, as well as obviously use your cash, you use your disposable income to buy assets, right? So if you have never worked a day in your life, but your ancestors were very, very successful and you inherited all their businesses, you are now wealthy, but you've never worked, right? Up until that point. So the idea of wealth being disposable income, I would challenge, and I would say I do not agree with that view of wealth.
Is a particularly important idea that you have to keep in mind when we're talking about tax.
And again, I agree with him. You do have to keep in mind however you define wealth, right? Because that will inform how you view any proposals and whether or not you yourself would consider them fair, right? So that is why I'm very pointed about the fact that I do not agree with Richard J. Murphy that wealth is about how much disposable income you have left over, right? That is not the measure of your wealth, right? Because you could be very frugal. For example, you could be on a very low salary, be very, very frugal, and have a lot of disposable income. You could live at home, for example, have no dependents, for example, have your parents cover all your rent, everything else, and you're on a relatively low salary, but you still then may have quite a bit of disposable income left, right? So I wouldn't describe that person as particularly wealthy either, right? It just depends on the situation. But categorically and objectively speaking, if you have a lot of assets, in my mind, that's a very binary view around, okay, you are actually wealthy because you have a lot of assets.
In the case of those with wealth, their income in a period exceeds their spending, so they save, and therefore they grow their wealth.
And again, I'm going to reiterate my point here as well, right? If your income exceeds your expenditure, that can help you become wealthy, but that in itself isn't wealth, right? It just means you have a path to wealth, and that's a good thing, right? And that's a very fortunate place to be in. And if you're in that position, you can consider yourself very successful, very fortunate, and on the right path. But if you fritter that excess money away on consumables, you buy a load of cars, as sort of you know, Mayweather has done, for example, then clearly you're not going to be wealthy, right? It then relies on you taking that income, that excess income, so to speak, and then investing, right? Or then acquiring assets, right? Putting that money to work, saving it, for example, right? That is the next step you need to take to then build the wealth. As he did actually say, to be fair to him, the point is though, is that having disposable income isn't wealth, right? And the reason again I keep going on about this is because anything that taxes that disposable income more, to me, is not taxing wealth, right? And that is why I'm challenging the idea of taxing high earners. That is why philosophically I'm against that view, because I don't view high income necessarily as wealth.
Most people spend almost everything they earn, in contrast to those with wealth, but the wealthy and the wealthiest can save large amounts every year. And saving creates tax opportunities that earning wages never can. And those opportunities reduce the tax liabilities of the wealthy. Our tax system rewards those who have or can accumulate wealth. So the question is, how does that happen? Let's talk through the steps. Step 1 is that wealth is turned into investment instead of income. When you've got money left over at the end of the week and you know you're not going to need it to meet some rainy day demand sometime in the near future, you can invest it in a way that turns that investment into what is called a capital gain.
Again, I disagree with this statement as well. And I guess you can probably, if you're following my train of thought, that's probably not a surprise, right? Because again, for me, the investment is the wealth, right? So as he previously described, the implicit assumption is that wealth is excess cash, right? It's just cash you have idle once you've covered all your living expenses and your necessary expenses, which you can choose to do what you wish to do, right? And if you think about what cash is an instrument, right? That's all it is. It's something that banks can just print, and therefore its buying power diminishes over time. And if it's a slow inflationary instrument, then it will slowly diminish, and you can rely on it for this purpose, things like the dollar and sterling, for example. But ultimately, the intention is that you spend it, right? That is what cash is for. So the only way to convert that excess cash into something that grows your wealth is to acquire an asset, is to put it into a savings account, which creates a debt instrument between you and the bank, or buy shares, right? Or do something along that line, right? Dare I say, even buy some crypto, right? But it's those things, it's the actual investment in this statement here that is the wealth. And then by doing so, it doesn't create a capital gain, right? It only creates capital, right? So you now have an asset, you bought it at a price, maybe you paid too little, and you got a bargain, or maybe you paid too much, and you paid a premium. But ultimately, there is no gain or loss at this point in time, right? You've simply taken the cash and you've now made an investment, and or you now have capital or an asset, right? And that's all that's happened. There is no gain, right? So again, to me, this statement is not technically correct.
Most people put their savings into a bank account, an ISA or something like that, and get a steady flow of interest. The wealthy buy capital assets. They buy shares, they buy land, they buy businesses, they buy farms. They do it to try to realize what is called a capital gain.
Again, they're not doing it to realize a gain because there is no gain that is realized, right? There is no it depends how he's defining capital gain, right? If he's defining it as, well, I had no capital and now I have capital and therefore I've gained capital, then I guess capital gain makes sense. But what I'm trying to emphasize here is that the concept of a capital gain from an accounting perspective, and he is a professor of accounting, is not one of acquisition. It's one where you have an asset already, you have an investment already, you bought it at, say, £100 in the past, you're now selling it at £120 in the future. So the capital gain happens when you sell the asset and you get this £20 gain, right? That is the capital gain. So simply acquiring an asset does not create a capital loss or a capital gain, right? And I think that is important to have in the back of your mind.
Profit on eventual sale, and the fact is, capital gains are taxed at much lower rates than income, even though both income and capital gains just put pounds of equal value into a person's pocket.
Yeah, and that's true, but I don't think they're necessarily the same, right? And this is kind of where this is going. It's right, if you're earning through a salary and you're being taxed at, let's say, 20%, why then, if you're receiving a capital gain, let's say, when you sell an asset, you're only subject to, at basic rate, let's say 18%. Like, why are they not the same? What is the difference? And I think for me, they're fundamentally two different things, right? If you are earning a salary, it is considered something that is relatively it's less risky. It's something you can rely on. It's something, obviously, the government can rely on in terms of tax receipts. And it's essentially unavoidable, right? You can't, if you work, you can't avoid that tax. Whilst if you have assets, either it's a forced sale because you're short of income or you're short of cash if you're an ordinary person and you need to sell, or maybe you're slightly better off and actually you don't need to sell at all, right? It's this very much ad hoc type, depending on circumstance type, transactions, which may or may not happen. And actually, from the point of view of investment, which is obviously something governments like to see, you would want tax arrangements that favor that, right? That incentivize that. So if people know they can acquire assets and then dispose of them, at a relatively low rate of tax, it would encourage them, I would say, to buy assets. Because ultimately, if you buy an asset, coming back to his point around capital gains, there is also the risk of capital loss, right? And that is why I say it's fundamentally different from a risk profile as well. So I would argue that you wouldn't necessarily, from a tax perspective, treat them in the same way, because from a tax perspective and an economic perspective, you may, as a government, have different incentives that you're applying to those two different things, right? And I think for me, a tax system should reflect that risk profile and that difference between the two, where salaried work, subject to the company being a going concern, is relatively risk-free, it's predictable, you know what's going to happen, versus something like, investing, which comes with its own risk, whereby, for example, if you buy capital, if you invest in capital, if you invest in assets, there is the risk that those assets lose money at the time you're looking to sell them.
It's totally unfair that gains are taxed less than income, and at the same time, it's totally unfair that there is no such thing as a national insurance charge on a capital gain, but workers do, of course, pay national insurance as well as income tax.
And again, this is probably why now we're starting to diverge. And this is why I went on that rant about why philosophically I don't view buying and selling assets the same as working, right? Because clearly they're achieving different things and have different risk profiles from the point of view of the individuals involved, right? So again, from my perspective, I don't think it's unfair that they have different rates. For example, I wouldn't consider, for example, applying national insurance on the selling of assets appropriate, because again, national insurance historically, in my mind, relates to work, right? It relates to building up a pension, a state pension, right? So whilst you're working, you contribute national insurance, and then as and when you retire, you then hope to receive a state pension. What has that got to do with buying or selling assets, unless your job is buying and selling assets, right? If that's not your job, you know, then I don't think applying something like national insurance would be sensible either, right? But this all comes back to the point of view around how Richard J. Murphy views assets, from a philosophical point of view, and how he views wealth from a philosophical point of view, versus how I see wealth from a philosophical point of view, right? So his line of thought is very logical. It makes sense. But I'm just saying I personally don't agree with this line of thought.
So not only do they pay higher income tax rates in most cases, they also pay national insurance as well, and the wealthy therefore avoid taxes paid by workers, and the same overall monetary gain receives a very different tax treatment as a result.
Yeah, and what I would also say actually is that this is not the reason why the wealthy are avoiding, right? It's not because the rates are different, because the implicit assumption is that the wealthy are selling assets to sustain their lifestyles, right? And clearly their asset holdings are growing from a net perspective, right? Their net asset position is always bigger at the end of the year and each year relative to the beginning of that year, right? So I don't think it's the rate. And then the other view might be, well, why don't we lower income tax rates so that they match capital gains tax rates, right? Why is it a race to the bottom? And we know why it's a race to the bottom, because obviously the government needs the cash, it needs the tax receipts. We all understand that, whether you agree or not, in terms of a wasteful government is a different thing. But I guess my point is that why is the argument to take the worst case scenario, take the higher tax rate and match that, right? I would argue actually, well, 18% basic rate is still quite high. If you're somebody, that looks for a small government and wants to see low taxes, right? So why don't we bring down income tax rates for the workers and have it, be lower, right? Why don't we do that? So that's another angle that could be taken. We know why it won't be taken, obviously. But again, I just feel like the rates themselves is not the issue, and it's not the thing that enables the ultra wealthy to avoid taxes, right? Because if that was the case, we would see their marginal rates of tax align with the CGT rates, right? We would see them paying rates of about 18% or 22% or whatever it is. And we're not seeing that, right? We're seeing rates closer to 1%, in some cases nothing, right? So to me, that's not the answer.
Step 2 in this process is that the wealthy hold their money through private companies. Now, private companies were never intended for this purpose, but they have become used for it.
Yeah, and he's right that they, are able to shelter a lot of their wealth and avoid taxes legally through companies. But I think I'm going to emphasize the word legally to challenge his point around this is not the intention. If this is not the intention, then why is it possible, right? And I understand what he's saying here is that, maybe, something has been exploited. But again, if that's the case, the government is in a position to close that loophole, which they've never done, right? So these arrangements have been in place for quite some time, right? I mean, I don't know the history of all of this stuff, but this is not new. It's well understood that special purpose vehicles have been set up for this specific purpose. There's a reason why some of these places are called the British Virgin Islands. The association with Britain is not, it's not a coincidence, let's say. So my view is it was intended for these purposes, right? And it's perfectly legal. It remains legal. So there's clearly no problem with the arrangement as far as the government's concerned.
Company profits face much lower rates of tax than personal income on the same equivalent sums, especially if the company is owned by a person who would otherwise be a higher rate taxpayer. And what is more, national insurance is not charged on company profits, either in the company or if the profit is withdrawn by way of dividend. And business costs reduce taxable profits in a way that income earned by a person from work cannot do.
Yeah, what I will point out here as well, a lot of what he's saying makes sense around profits being much more tax favorable than income. And obviously dividend income is a good example of this as well, although there's been a lot of restrictions around how much dividends you can take tax free. But the reality is, if you do have a company, you're not the profits belong to the company, right? I do want to be very, very clear about this. The only way an employee or a director even can extract that profit out of the company is to pay themselves, right? Or there's other arrangements they can make to extract money out of the company, which I'm not going to go into here. But what I'm trying to say is that unless the director does something to transfer that money out, then the money belongs, or the profits belong to the company, right? So the fact that the company itself has a low tax rate, in my mind, is neither here nor there, right? It's almost a red herring. It's like it doesn't really matter whether it's high or low, because every company will be subject to the same issue, right? Depending on where they choose to headquarter. The point is that from the director's perspective, those profits don't belong to the director automatically unless they do something. And the typical way, a director will extract money out of a company is by taking an income, which would then be subject to income tax.
Undistributed profits from a company avoid personal income tax altogether. Companies provide long-term tax planning vehicles then, letting savings grow in a low-tax way. The company is then a gift to the wealthy who want to avoid their tax liabilities.
Yeah, and a company, depending on what it is, that's one way of putting it. But companies are special purpose vehicles in my mind, intended to benefit the owner in some way, right? That's their purpose, right? So one could say, well, okay, if the sole reason of the company is to help the owner avoid taxes they otherwise would pay, that's not ethical, I guess, but it's allowed, right? So the governments are allowing it. They probably have treaties with these territories that are offering, these zero corporation tax rates. And ultimately, from a business perspective, that has nothing to do with the director, because even if the business itself has a zero rate corporation tax, it doesn't mean the directors or directors of the business, when they take an income, if that's the way they choose to receive an income from the business without doing anything more sophisticated, they will then be subject to income taxes based on their own domicile or residence situation, right? So just because you have a company in a low tax jurisdiction doesn't mean you've successfully avoided tax if you then choose to pay yourself, is essentially what I'm saying.
Step 3 in this game is moving offshore. I know that offshore tax planning is much harder now than it was before I began tackling it in the early part of this century. We have made going offshore harder. I'm delighted about that because I worked very hard to achieve that outcome. But the fact is, offshore tax planning has not completely disappeared, and low tax jurisdictions, or secrecy jurisdictions as I call them, still attract wealth. Complex structures can still reduce UK tax bills, and international wealth remains easier to shelter in tax havens than it should be. The richest still have choices that others do not. We need to close down offshore. Step 4 involves VAT. This is a complex area, but one worth paying attention to, because this mundane tax is heavily biased against ordinary people. Remember, VAT is a tax on your spending, and by definition, those who are wealthy, or those who are saving, spend less than all their income. Now,
Yeah, and this is where I do agree with Richard J. Murphy here. VAT impacts those who are working and who are poorer the most, because it represents much more, their spending represents much more of their overall wealth and their overall income, right? So when he talked about this gap between your earnings and what you spend, this is where his definition makes more sense, right? In this real world scenario where you're taxing spend, right? If you're taxing wealth, then it doesn't work in my mind. But if you're taxing spend, then his analogy does make sense. Because clearly what it does is it closes that gap even further, and reduces your disposable income even further, and then reduces your ability to generate or become, or create wealth by acquiring assets or making investments or saving. So I would agree here that VAT can be viewed as a regressive tax, which clearly is going to impact those who are on the breadline versus those that have a lot of money already, and who may find VAT just an inconvenience and an annoyance more than anything else.
Most of us spend all our income or almost all our income every week or month. But the fact is, that means that we pay VAT on a great deal of our income. So after we paid income tax and national insurance, then we pay VAT on quite a lot of the rest of what we spend. But the wealthy do not spend all of their income. They spend a much smaller share of their income and therefore do not pay VAT on it. By definition, therefore, the wealthy pay less VAT than do ordinary households. This is what is called a regressive tax. The lower your income, the higher your likely tax rate is going to be. And that is a problem built into the VAT system in itself. The VAT system, and this is step 5, is designed to favour the wealthy, and our politicians are not doing much about this. Much of what the wealthy spend attracts no VAT. There's no VAT on buying a second home. There's no VAT on financial services. There's no VAT on private healthcare. There wasn't VAT on education until recently, and didn't you just notice the furore when Labour tried to do that successfully?
Yeah, and I think again it comes back to my race to the bottom argument, right? I do agree with him that VAT is regressive, and it should be fairer with respect to the very wealthy suffering it just as much on the things they spend versus the very poor and on what they spend money on. But I don't believe the answer is this race to the bottom necessarily, for example. So this VAT on education, for example, um, for me was a step backwards, because what it's basically doing is it's preventing, the upper middle class and aspirational parents that have made financial decisions to get their children into these schools, are now finding themselves in a situation where they just simply can't afford those schools anymore. So the very, very wealthy, they're going to be annoyed, but it's kind of like, well, whatever, we'll just take it on the chin. But there's going to be a huge demographic, of people, certainly in the upper middle class, who suddenly find themselves in a situation where, what, we just can't do this anymore. And I think for me, that's really quite rough, because the idea in my mind should be about raising standards of state and free schools, right? And arguably, if they were going to take this VAT, it should have been ring fenced for that purpose, right? So they should have taken this additional VAT that they're now applying on private education and ring fencing it for investment in state schools and public schools. In the same way, what they should be doing with local emission taxes, for example, is taking that tax and ring fencing it for the purposes of developing, zero net, or neutral technologies, right? Or investing in the energy sector, or helping build, national power, right? But the government just doesn't do these kind of things, right? They just take these additional taxes, I find, lump them into this pot, which they then use to continually cover their ever increasing daily running costs, right? And even national insurance, which he talked about actually with respect to taxing assets, and capital gains, it's not ring fenced for the purposes of creating a sovereign pension fund, right? So in the end, all it does is they just take the money and just cover the day to day state pension needs of an ever growing and ever larger elderly population. So this for me is the big frustration with government. Actually, it's like, it's the worst of both worlds, right? You're penalizing aspirational parents in this example, but then you're not even taking that money, in my mind, there's no evidence of this, reinvesting it in something that then improves the overall standard of free or state education to soften the blow for those parents that no longer now can send their children to fee paying schools.
So let's talk about step 6 in this process. That's around inheritance tax. Inheritance tax is the most hated tax in the UK, supposedly, although that's mainly because the Daily Express always talk about it as a death tax, which it isn't, and they always talk about it as though it's a curse on everybody, when only about 5 or 6% of households in the UK ever come to pay this tax.
He's right that most people will not have to worry about inheritance tax simply because they probably won't be rich enough. But that is going to change, just so you're aware. I'm sure you may be aware of this already. If you follow channels like mine or even Richard J. Murphy's, is that there will be a change whereby your pension fund will be considered part of your inheritance estate, which previously that hadn't been the case. So although the allowance is actually quite generous, I would argue, because again, as he says, most people are not impacted by inheritance tax, that will change because they're now basically including your pension, which means a lot more people now will have to start thinking about inheritance tax. So I'm just challenging this idea that although it doesn't impact many people now, the expectation, I think, from the government, based on the changes they've made, is that it will be impacting more people in the future. And that's the intention, right? Clearly.
Tax. But having said that, most families that do pay tax have little chance of avoiding much of it. Why is that? Because a lot of their wealth is inside the family home, and that can't be got rid of until either late in life or on death, and that means it's very difficult to avoid inheritance tax charges.
But it can be avoided, right? Again, it's not something I'm going to discuss in this video. I don't think it's a good idea for anybody to be giving tax planning advice online. But it can be avoided, is all I'm saying. And the very wealthy can and do very effectively avoid it, right? Even if the majority of their wealth is the family home, there's still ways of avoiding it. It's not straightforward. I don't disagree with him when he says it's not easy. It does come, obviously. It's just not straightforward, but it can be done. There's methods of doing it, and many people do it, including politicians.
For the wealthy, although their houses might be worth a great deal, that is not true. They'll have multiple houses, so they can get rid of a lot of them to the next generation way before they die, and they can hide their assets away in trusts or just give them away to their family.
That's what I'm talking about, right? He knows this as well, right? Which is why he's mentioning these things. So again, based on what he said, we know there's ways of avoiding it.
Families during their lifetimes, and if you give your assets away more than 7 years before death, in most cases, that will mean you won't pay inheritance tax.
There you go. That's another way of avoiding it. So he's talking about potentially exempt transfers in that example. So that's another potential way of lowering or eliminating your inheritance tax obligations. So you can avoid it, is basically what I'm saying. And it's also what he is saying.
And they can afford to do this because they've got so much they can go without the income and the capital gains that wealth gives rise to. They can afford to avoid tax. As a result, the wealthy tend to do so and very often pay lower rates of inheritance tax on the value of their estates than do those who are people who think themselves middle class. Their tax system helps preserve big family fortunes. And then there's step 7. The council tax system in England and in other parts of the UK favours the rich. Higher value properties are taxed at lower overall rates than lower value properties in a way that is deeply unfair and discriminatory, and multiple property ownership rarely results in sufficient additional charge.
Yeah, he's right here. And that's why things like the mansion tax, which Rachel Reeves introduced, and also I believe Andy Burnham is considering a land tax in the same mold, which would be based on a valuation. But then the question in my mind is, well, what is the tax for, right? So council tax, in my mind, was around essentially creating a tax to support local services like, collecting the bins, keeping the roads up to date, um, you know, helping schools, that kind of stuff. So it's not really got anything to do with the value of your home necessarily. Whilst obviously, if we're now saying council taxes should be based on your ability to pay, that's where a valuation or value, linked tax may make more sense, right? So it really just depends what you think council taxes are for. But if the idea is that it should be targeting wealth, again, I don't think effectively will do that at the ultra wealthy level, right? So if you're just talking about middle class and downwards from an economic perspective, then yeah, it may work, and it arguably will work. But if the idea is that you're taxing the ultra wealthy um, by taking into account the value of their home, um, I think you're going to see very mixed results, if not the results you desire from a tax perspective.
While some forms of land, like sporting estates, aren't taxed because they're supposedly agricultural property, they should be. They are just sporting venues for the wealthy. We have a land tax system that is biased to wealth in this country, and that is deeply unfair. In summary, workers pay income tax and national insurance. Workers also pay VAT on most of what they buy. Wealth often avoids all three of these taxes whilst paying too little council tax as well. The wealthy do pay corporation tax and capital gains tax, but these are at much lower rates than the income tax rates that they should be paying, and there is no national insurance charge in most cases. Therefore, their overall tax burden is much lighter than that of ordinary people. This is why we have a regressive tax system in the UK. The tax system we have is designed to help both create and preserve wealth, and is designed to impose tax injustice on ordinary people. So, do we need a wealth tax then? My answer remains no.
Yeah, so this is what I was saying before. And again, we'll be interested to hear why he thinks it's no. And I think we do need more highly educated people like Richard J. Murphy to tell us why it's no, right? So again, let's just hear actually. Yeah, let's see what he has to say.
Because all of these issues need to be addressed first. If we put a wealth tax onto a system which doesn't work, we leave a system that doesn't work, and all the sense of inequality and injustice that surrounds it. A wealth tax might sound attractive, but they're very difficult to implement. They affect relatively few people. Valuation creates massive practical problems and lots of disputes, and the revenue would take time to arrive because getting this tax into place would take a long time, and then imposing it would take longer still.
Yeah, so if we look at all these objections here, wealth taxes affect a few people, kind of in my mind. Again, it's something Gary Stevenson has talked about as well, but that kind of offsets much of the other objections he has, right? The intention is that it should only affect a relatively few amount of people. Therefore, it warrants the effort of, if we need to, having those disputes, right? And to be fair, HMRC does have legal disputes with those that they think are avoiding tax when they need to, right? Under the current regime, right? If I was just to move abroad, but my family remained here, then and I decided I don't want to pay income tax, then they would dispute it, right? And if a lot of us were doing it, they wouldn't say, "Oh, okay, there's too many of us doing it. We're not going to dispute it." They would just triage the situation and go after whoever they need to, and they'll just go through the list, and eventually they'll get through to everybody. So I think from my perspective, it's a dispute worth having. Actually, if there's billions of pounds on the line potentially, I think it's a good use of government resource, I would argue. I think collecting the tax taking a long time, I think is fine. You can just put a payment plan in place. And I think that can be very, very helpful. Again, provided you can agree what that tax amount should be, the length of time it takes to collect is not a problem. And imposing the tax being very hard. Well, I think, yep, it may be hard, but I also think it's worth it. So The idea that it's hard, and again, this is the same view Gary Stevenson has as well. So it's not that I'm inventing this idea, but I do agree with this train of thought. The idea that it's hard is not, for me personally, a good enough objection, right? Because for me, the objection has to be, is it valid or is it not valid? And I think the better objection he had actually was what he said preceding all of this, i.e., if you have a terrible infrastructure, you can't build a castle on sand, essentially, right? And I would agree in that respect and take that more seriously, that look, if the tax regime as it is completely ineffective, then what's the point of introducing another tax which will also be equally ineffective because the infrastructure is ineffective, right? So that to me is more of a valid objection. But what he's not saying ultimately is that, in my view anyway, is that the idea of the wealth tax is invalid. He's simply saying he doesn't think one is needed because either we're not ready for it now and or it's too difficult. And for me personally, they're not good enough objections.
It's better to reform what we've already got when that is a source of major injustice. We should start where change is easiest, in other words. We need to fix what can be done with ease.
And I think this is, to me, is the crux of my objections and issues with this train of thought, right? So I'm not going to say Richard J. Murphy specifically because he's not the only highly respected person that has this mindset where, why fix what is not broken, essentially. And my own view is that it is broken, right? And therefore it needs a complete dismantling, actually, because my concern is, if I'm being honest, is that taxing income is just easier, right? So we just have this mindset that it's easier to tax people that are not mobile. Workers are just not able to just move around and leave the country, right? It's easier to tax income because there's a paycheck that tells you the value of their services versus there's an asset that needs evaluation, right? It's easier to tax income because we can make the employer do it rather than assets where we have to maybe have an argument and a fight with an army of solicitors, for example, right? This ease, this convenience is not acceptable in my personal view, right? That cannot be the position we take to argue that, okay, fairness and easiness correlate. That's the way it should work. So for me, that is my concern. It's like, if we keep saying it's easier to do things and let's go down that road, then we might as well just carry on taxing income because that is fundamentally and objectively easier than taxing wealth, right? That's my issue here.
What is that? Well, we can do these things. We could equalise income tax and capital gains tax rates. That would raise at least 10 billion a year.
No, it wouldn't necessarily do that because that figure would be based on current asset disposal behavior, right? So I don't want to say naive because, again, this is a professor we're talking about, but equalizing income and capital gains tax would assume that projected asset disposals and capital gains when you make those disposals are going to be the same. And clearly that may not be the same, right? Market conditions will be different. Personal conditions will be different. So even if the number of asset sales are the same, they might be losses, right? So this idea that it's going to raise another 10 billion a year, maybe it's factored all these things in that I've mentioned, but it's very hard to predict these things in the future, I would argue. And it will mean actually that, the upper middle class and the very well wealthy, they will just not sell assets as much. And equally, they may not invest as much actually, because again, there is that risk that you may lose, that, you may make a loss. So you might be hesitant about doing that unless you're very, very sure you can hold those assets long term, for example. So again, I don't agree with this premise and I don't think it's the answer. And I don't think, more specifically, it targets wealth and the very, very wealthy enough.
We could apply a national insurance equivalent to higher investment income.
Again, I'm going to say no for the same reasons.
We could increase the corporation tax rate in this country.
Again, I would say no. And the reason why I'd say no to corporation tax, essentially, is because you can, how do I put this? Um, Corporation tax is based on taxable profits. So this is the taxable profit. You can, and you've got still got loss reliefs, right? For example, and the profitability of your business from a legal perspective has nothing to do necessarily with your own wealth per se. So you could have a loss-making business such as SpaceX and still become a trillionaire, right? So there's not this sort of alignment, this one-to-one, and he would know this, by the way. But there isn't this necessarily alignment between I have a profitable business and therefore I am having a high income because I have a profitable business, right? You could have a loss-making business, still be taking out, a large amount of salary, and still be arguably generating shareholder value, which seems to be the case with Elon Musk, and on paper become a trillionaire, right? So how does increasing the corporation tax result, say, in someone like Elon Musk paying more income tax or personal taxes, right? How do we make that link between the two? So I don't think, in my mind, the corporation tax is the answer. And we have seen corporation tax increases, right? So the UK actually recently increased. So under Richie Sunak, for example, when he was prime minister, I believe, he actually did increase corporation taxes. And did we see a significant increase in the amount of taxes the wealthy people were paying? And or did we not, were we seeing wealthy individuals just headquarters somewhere else, right? They would still have that option, right? So if you increase corporation tax, to a place where they consider it too high, suddenly Ireland looks more attractive, right? If not already, suddenly, you've got, the British Virgin Islands, right? You've got wherever, right? That where, corporation tax rates remain at zero. So I don't think raising corporation tax is the answer. And based on past history and recent history, it hasn't shown itself to be the answer.
Quite straightforwardly, far too low as it stands, because people are not paying for the privilege of limited liability that incorporation provides. But we could do something else as well. We could require that all private companies in the UK distribute their excess profits to their members or be deemed to have done so.
Yeah, so I'm just pausing it here as well. We can read what it says here. And I think from my perspective, having distributable profits or excess profits or reserve profits going to shareholders, again, it would companies want to headquarter in the UK if that's the case, right? And that's another challenge we've sort of had, and another sort of objection that has been made around raising taxes in the UK in general, right? And I don't think what is being proposed here solves that problem either, right?
This would mean that those profits would become income subject to income tax in the hands of the shareholders in those companies via something called an investment income surcharge, something that we had until the mid-1980s when Margaret Thatcher got rid of that. We should also make offshore avoidance much harder, and we should extend VAT or equivalent taxes to financial services and trading.
Yeah, and I disagree with all of those things as well. And again, it's probably for, to keep it very, very simple, the same reasons, right? Sort of tweaking the rates in the existing system. If those things were the answer, we would have seen the fruits of those things already, right? These, as he mentioned there, Margaret Thatcher, before Margaret Thatcher, that thing was in place. Did we see a significant increase in the tax what the wealthy were paying? Probably not, right? So although that may have correlated with a sort of time of economic prosperity, again, correlation is not necessarily causation either, and that's a well understood principle. So from my perspective, simply playing around with the rates of taxes in the existing system, if it was as simple as that, I don't think we would be where we are today if that was the case. That's the simplest way I can put my own objections.
We should also be looking at closing inheritance tax loopholes used by the wealthy.
Yeah, and I do agree with that, right? So the inheritance tax loopholes for the very, very wealthy, some of them he mentioned, so things like trusts, for example, and I'm only mentioning it because he mentioned it. And again, this is not inheritance or tax planning advice, I think we should be looking at that. But I think my own position is that philosophically, any loophole that the very wealthy can take advantage of, they have to be looked at to see, okay, can ordinary people also take advantage of those loopholes? And if the answer is no, then my own feeling is that that loophole should be shut down, right? So it's not about a race to the bottom in my mind. It's more around fairness, essentially. So on the one hand, I would argue that loopholes should be looked at, and if they can't be accessed by everybody, we should be looking at potentially closing them down. But equally, I wouldn't suggest that, okay, because the very, very wealthy are not paying as much transactional taxes as everybody else, let's make the very wealthy pay more transactional taxes. I would argue, actually, let's look at how we can reduce transactional taxes for the very, very poor, right? Because that is more aligned, for example, with Labour's position around ensuring, you know, the cost of living is not going up and up and up, right? So that would be my position on those two things.
At the same time, council tax on higher value properties should become a proportion of the total value of the property.
And again, I disagree with this as well. And the reason why I do disagree with this is just philosophical. It's the same reason I object to the mansion tax. It's the same reason I would object to a land tax that is affecting residential UK citizens. Because just because your home has a particular value, and again, you could put the same objection he raised regarding a wealth tax, right? It could just lead to disputes, right? You could just dispute whatever valuation the government or the local government decides your house is worth. You're having to find money to pay the tax, right? And the only way you can do that is if you keep working, because it's not like you can sublet your room, for example, because it's your private residence, right? You're not going to want strangers living in your home to give you an income to then allow you to pay the tax, because the whole premise of the home's value is based on demand as and when you sell it. It's not based on value in use, right? So if it's based on value in use, then I would agree with a land tax, because you could put the asset to use, generate some passive income like a landlord would, and therefore some of that income should then be used to pay the tax. But if you're simply living on land, if you're simply living in a house, it's not an asset in use, right? It's a resource. It's something that provides you security and shelter. And on that basis, unless you sell the house, you cannot monetize it, right? And a good thing to think about when it comes to something like this is, imagine if you're retired, right? Um, you don't have the means to go out and work. You're vulnerable because you're older, so you don't necessarily want, as I say, to rent a room out and have someone else come in, but yet you're expected in perpetuity to keep finding this money to pay for this land tax. And I think for me, that's clearly going to hit and damage and stress ordinary working people more so than the ultra wealthy, even though the ultra wealthy would be, again, disadvantaged with this as well, I would say. So for me, this is not something I would ever get behind, I'm afraid.
So that we collect a fair amount of tax on those higher value properties, and we should be charging tax on things like supporting estates. And second properties, or third, or fourth, or fifth properties should be subject to higher rates.
Yeah, so I don't necessarily have an objection to second, third, fourth properties potentially being subject to this type of tax. Certainly not your primary residence, but these other ones, I would say, well, yes, because you had the opportunity to put them into use without putting yourself in a situation where you're vulnerable, right? So, and arguably, we should have homes for people that need them. So, on that basis, I would argue that, yeah, you can consider it for second, third, fourth, and fifth homes, because that clearly is part of somebody's wealth portfolio, but certainly not your primary residence.
Do all of these and we would have a better tax system. They're practical, they're easy to do, they could be done now. No new taxes.
Yeah, and I would argue you would have a worse and more aggressive tax system, actually. And the defense can't be, well, at least it's easier and practical. Because I think this has been the source of the problems we're seeing today, where the government is thinking about what they need to do to raise taxes, and they're afraid to do the hard thing, and they lean towards the practical, easy things to do, which means I'm afraid to say, in my opinion, it's those that work, it's those that are, sort of modestly wealthy, let's say, that are going to be suffering the most, whilst the very, very wealthiest in society, the 0.01%, they tend to be kind of invisible, it seems, from a tax system perspective, as Richard J. Murphy has acknowledged.
Required, and critically, all the information to put these charges in place already exists. It's on current tax returns, current council tax valuations, inheritance tax declarations, and so on.
And I would dispute that, because you wouldn't know. All the information doesn't exist with respect to land or home valuations, right? That doesn't actually exist, right? So coming back to his original point around personal wealth, the same objections would apply, right? If you can value someone's home, then you can value all the other assets they have, right? If you consider a home an asset rather than an essential resource. But if you can dispute wealth, then you can dispute the value of your home, clearly, right? So until there's a sale, you don't know what your home is worth, ultimately. So yeah, I don't buy into this idea that much of this infrastructure exists, because some of it actually doesn't. A lot of it, what it does, as he says, and rightly so, but a lot of it, or some of it, doesn't. And the bits that don't would have the same objections he raised earlier around the idea of an overall wealth tax.
Data is there. All that is required is the political will. Evidence that these reforms would work is also already available. Some of the things I've suggested existed in the past. The legislation has been proven. The changes are technically straightforward. The revenue gains would be substantial. Add up all the things I've just talked about, and we're talking about well over £50 billion a year. If the goal of a wealth tax is to simply reduce inequality, these taxes would work better than.
No. So again, I would disagree. These things he's mentioned may increase the amount of tax that the government receives, but it won't address wealth inequality for the reasons I've outlined. And I think, for me, unless you are prepared to tax the very, very wealthiest in some way, whether that be a wealth tax or some other kind of tax, you're just going to see more and more wealth inequality, I'm afraid. So, I have to respectfully disagree with Richard J. Murphy here on that point.
These changes would be capable of being implemented in stages, which would make it easier politically to do, and politicians would not have to face the same fear of upsetting the wealthy in the way that a wealth tax will do.
Yeah, and I think he's right. They wouldn't have to fear upsetting the very wealthy in the same way a wealth tax would do, but then you're upsetting the people that aren't wealthy instead. Right? So it's like, manage the expectations of those that aren't wealthy by doing it slowly, but let's not upset the very, very wealthy. That sounds very familiar, I'm afraid to say.
But they also challenge the deeply unfair tax system we have, and will send out a vital message to people, which is that we would have a government that cares.
I don't think the message that people would be getting is that the government cares if he was to follow all of their proposals. So let me remind you what they were, right? So it's to equalize capital gains tax. So you pay more capital gains tax on any assets you um, sell. Increase VAT pretty much for everybody, right? So that it's equalized. So again, this race to the bottom. Remove any means of avoiding inheritance tax. So again, if you're upper middle class, and the £1 million isn't quite enough for you, and you've got assets you're handing over, say 3 million, 2 million, good luck with that. Introduce more corporation tax, which may mean jobs go elsewhere because companies are headquartered elsewhere. I don't know if the impression I would get is that a government that does all these things cares more about workers. I don't think I'd come to that conclusion.
As it stands, subsidizes the accumulation of wealth. That is one reason why the wealthy stay wealthy. Ordinary taxpayers are helping finance that privilege by paying too much tax. tax is being paid by the wrong people in the UK, and fair taxation means taxing wealth like work.
Yeah, which has not been achieved with his proposals, right? For the reasons I've outlined. And it's interesting that taxing wealth just somehow means taxing workers more, right? So everything he's suggested, in my assessment, would end up meaning the likes of me and you would be paying more taxes and find it harder to avoid the taxes we were able to avoid in, previously, right? So I can't see how any of these things impact billionaires or trillionaires in any meaningful way, is basically what I'm saying. Like, have a think about this for yourself and think it through. But I'm not connecting the dots, I'm afraid to say. And nothing he's said explicitly makes that connection for us, right? So for me, the assessment I'm getting is the same assessment I suspect the likes of Labour and the Conservatives would give. The current system is fundamentally okay. However, we're just not applying it effectively enough, or we haven't optimized it as we should. And there's a communication message. So therefore, let's play around with the bandings. Let's play around with the rates. Let's tweak a few of the loopholes. There you go. Problem solved. And by the way, we can't upset the very, very ultra wealthy, right? That's kind of the sentiment I'm getting here, which kind of feels very, very familiar. And if I'm being honest, very tired from a political and economic standpoint.
Tax reform is a political choice. It's not a technical problem. All of these changes are deliverable. I could write the legislation tomorrow. I have written legislation before. I know this is deliverable. There's no umming and ahhing required.
I don't think the issue is whether this is deliverable or not. And I don't think, again, that's the reason why it's if you're thinking about pros and cons of something, just because something is deliverable, it is a pro technically, but that doesn't mean, that's the tiebreaker, right? That's the thing that sort of brings it over the line. It's like, okay, we want a wealth tax, but that's like super, super hard. But this thing over here is deliverable. You know what? Bin the wealth tax because this thing is doable, right? It's like, I don't think it's as simple as that.
We can get on with it. The question is, do our politicians have the courage to act?
Yeah, so we're going to leave it there, I think, because I think to some degree, I think, I've made my point. I think Richard J. Murphy has obviously made his case as well in terms of the video here. And I think for me, as I say, it's always really useful to hear from counter arguments. Where we can, we should stillman their position and try and think, okay, well, why would what they're saying work? Why would it be valid? What is the weaknesses within our own position? And I think from my perspective, maybe I could have done that better, if I'm being honest. But the reason why I've not felt the need to stillman some of his arguments as much as I may do, is simply because many of these arguments I've heard before, right? These have been addressed by the likes of Gary Stevenson. These are things I've heard, in terms of my own discussions, and therefore I'm not compelled by what I'm hearing, essentially. And I think for me, that is the ultimate conclusion I've drawn from this, right? Ultimately, the main objection seems to be we're going to upset the very wealthy, and the implications around that are well understood. And I don't see how raising corporation tax, addresses that potential risk of capital flight, for example. If it's done in isolation by the UK only. This idea that it's too difficult, it will lead to disputes, and we have rocky tax collection foundations, is all the reason why, in my view, we should actually be looking at this, right? Because if we understand it's a problem, but there's a lot to be gained from a societal perspective and potentially from a tax receipt perspective in terms of then thinking about infrastructure and allowing the government and ordinary people to have a fair share of assets, whatever you consider fair is, and stop this growing inequality, then I think we need to look at the solution that is hard but is best, right? If the solution is best, even if it's hard, I think we should still consider it. And nothing he said to during this video has convinced me that it's so the cons outweigh the pros, i.e. it's so hard that we should just not do it. And I think, unfortunately, the proposals around taking what we have already and applying basically more aggressive tax rates on those things, to me, is a situation that becomes more aggressive. I think it starts looking like a race to the bottom, unfortunately. And I think, the worst case scenario in my mind is that it just ultimately leads to people feeling like, I don't even want to work in the UK. I'm going to take my talent elsewhere, right? So I think you're going to get basically brain drain. I think there's going to be more of a push around that. And people are just going to go to places like Dubai, America, Switzerland, where, despite the tax regimes they may have, they just might feel they're going to get a better quality of life ultimately. So, I'm afraid to say, as much as I respect Richard J. Murphy, much of what he said here, I do actually respectfully disagree. But I think that's okay, right? We are allowed to disagree with people. And he's allowed to take the view he's taken. He's clearly someone that's very, very successful and knows what he's talking about. But despite all of those things, I think from my perspective, I've not felt challenged enough yet to think about shifting my own position. So that journey will continue, I guess. So hopefully you found that useful. And until next time, take care. Peace.